Hello students, you are the future chartered accountants of India. I am CA Abhijith Acharya, welcoming you all for today's video classes, that is Abhi CA Classes. We have already seen three parts of this PGBP chapter, and today we are going to complete the part 4 of this PGBP chapter. And there would be a remaining one part, that is part 5, which would be coming soon. So without wasting further time, we'll continue the remaining parts of this chapter. Section we have discussed it till section 3580, that is specified business, right? We are now going to section 36, that is certain deductions under section 36. Okay, 36 subsection 1 subclause 1 says that premium for insurance of stock in trade. Let's say, for example, you have stock in trade in your business for which you are paying insurance, that is allowed as per income tax authority. If you are debiting any insurance premium with regard to their stock, then it is also allowed. No deductions would be there, it is allowed. So no disallowance would be there, it is allowed. Okay, next, section 36 section 1 subclause 1b, it says health insurance premium paid for employees. It says if you are an employer, if you are paying employees insurance on behalf of them, then that would also be allowed as per income tax act. There would not be any disallowance. Okay, but one restriction is that it should be paid through other than through the cash. You should be paid through non-cash transaction. There should be a non-cash transaction with regard to that health insurance premium. Okay, next, section 36 subsection 1 subclause 2, it says bonus or commissions to be paid to the employees, it's also allowed as a deduction subject to section 43b. What is section 43b? We'll discuss in detail in the last part of this chapter, and as of now it is very simple. Allowed as a deduction subject to section 43b. In brief, I am ready to tell you that 43b says that the payment should have been made on or before the due date of filing income tax return. This is a brief, not going too much on this, but we'll discuss in detail in the last part of this chapter. There is no restrictions on the amount of bonus, and it may exceed the bonus payable under Payment of Bonus Act 1965. There is no restrictions of the payment in terms of the in respect of the taxation perspective, but as per bonus that particular act, there would be a restrictions, but while seeing the allowable amount, there is no restrictions. Okay, whatever has been debited in the profit and loss account as a bonus paid to employees, that is fully allowed, but only restriction is that is subject to section 43b. Next, section 36 1 subclause 3 says interest on borrowed capital. If your profit and loss account says debited, profit and loss account is debited with interest on any loan, then there would be some classification. If it is borrowed, that loan is borrowed for business or professional purpose, then if that borrowed amount is from bank, public financial institution, PFI means, and state financial corporation, state industrial corporation, and NBFC, that is non-bank financial corporation, it is allowed subject to 43b. What is subject to 43b? We'll discuss in detail in the last part of this chapter. If you have borrowed the loan from any other sources other than these categories, then that is also allowed. There is no mention about 43b. Okay, then personal purpose, if the loan is borrowed for personal purpose, then it is not allowed, because we are focusing on PGBP chapter. It says profit or gains from business or professional, right? So if it is for personal purpose loan, then it is not allowed. For example, if you have taken a loan for your self-occupied house property, let's say a housing loan, it's your absolutely, it is personal in nature. If you are debited that loan interest amount in your profit and loss account, obviously it should be disallowed, because it is a non-business interest, right? Non-business expenses, so it has to be disallowed, it has to be restricted. Okay, next, section 36 subsection 1 subclause 3a, it says discount on zero coupon bond. It says, what do you mean by zero coupon bond? There will be a bond which will be cleared through one example. We have mentioned one example through which you can be able to see. In brief, it is means it is issued on discount. That's it. Let's say for its value is in the market is 100, but you are receiving it. Let's say for example 80 rupees. 20 rupees is a discount. Okay. Then pro rata of amount of discount shall be amortized over the life of that ZCB, that is zero coupon bond. We'll take an example. A Limited issues ZCB of 50,000 on 2nd January 2024, that is 2023-24 financial year, previous year, at the rate of 70, whereas its face value is 100 rupees. You can see the difference, that is 30 rupees is a difference. That's called a discount for one zero coupon bond. But here in this example, 50,000 zero coupon bonds have been issued, and hence it redeemable after 10 months. 10 months means 31st, let's say 31st October 2024. And deductions would be as follows. In the pre-discount amount would be 50,000 into 30, that is 15 lakh. It's a discount amount spread over the 10 months. But that's to what you, and how much would be the monthly discount if you divide the 15 lakh among 10 months, then you will get 1,50,000 per month deductions, not bonds or discount amount. So in previous year 23-24, only 3 months are pending, that is January, February, March. So we have to count for 3 months 1,50,000 into 3 months, that is 4,50,000 is a discount amount that can be allowed as a deductions in your profit and loss account in the 23-24. The remaining 7 months, right? 1,50,000 into 7, that is 1 lakh. Let's say for 4,50,000. The remaining 10,50,000. Sorry for the delay. And remaining 10,50,000 can be allowed as a deductions in the 24-25 financial year or previous year. It's the case maybe. I hope you are understanding. Next, section 36(1) subclause 4 or subclause 5. We'll discuss both subclauses in one shot. Employer's contribution. I am focusing on the word employer's contribution for the benefit of employee. What would be the benefits? Number 1, if employer's contribution to the statutory provident fund, a recognized provident fund, approved superannuation fund, approved gratuity fund, and other fund as may be prescribed by the respective law, that is allowed. For whom it is allowed? It is allowed for the employer in his profit and loss account. It is allowed as a deductions subject to 43B, which we will discuss in the last part. And the employer's contribution to the unrecognized provident fund, unapproved superannuation fund, unapproved gratuity fund, and any other fund, it is not allowed. If it is being debited to the profit and loss account, we have to add back to the profit and loss account. That is simply we have to disallow that. That is not allowed. Okay. Then section 36, subsection 1, subclause 4A. It says employer's contribution towards pension scheme, that is national pension scheme, under section 80 CCD. It is not talking about employees' contribution, because employees' contributions can be taken as deductions under section 80 CCD, which we will see in the deduction chapter 60 deductions. But here we are taking, it is an expense to the employer. He has debited that expenses in his profit and loss account, but it is restricted to some of the calculations as per Income Tax Act. What do you mean by that? The deductions allowed to employer subject to 43B. Here also subject to 43B is a must. Okay. Actual contribution made by employer to the employee's pension scheme is portion, or the 10% of salary. Salary includes the basic plus DAT. DAT means, if you have forgotten, please revise the salary concept. DAT means DA in terms. The DA being dearness allowances, which would form a part of your retirement benefits. We have to calculate the both two, and on that we have to compute the 10% of the salary. We have to take the entire year's salary. Okay. Whichever is lower can be allowed as a deduction. For example, whichever is lower might in our computations, let's say 80,000. but employer has debited 1 lakh amount in his profit and loss account debited, so we have to disallow the 20,000. We have to add back 20,000 from through which the profit has been reduced, right? So we have to add back 20,000. Ultimately 80,000 is allowable. Okay. Next one, section 36, subsection 1, subclause 5A, it says, here now we are discussing about employees' contribution towards welfare fund. Any amount received by employer, let's say I am an employer, I am receiving this contribution from employee towards his contribution only to Provident Fund, Superannuation Fund, ESI, etc. is deemed to be PGBP if such amount is not deposited in the respective fund up to the due date to the such a fund. We have mentioned the due date of such a fund. Let's say, for example, we have discussed a PF due date, a Provident Fund due date, that employees contribution to be deposited to the fund in the subsequent 15th date. For example, this is a February month. February month ka PF ka amount should be deposited, should be paid to the respective fund within 15th of March. If it is not being paid on that due date, then it would be disallowed in the employer's books of accounts. Remembering? Right. So, any amount received by employer from employee as a contribution to the employer is deemed to be the PGBP. To employer, I am specifically focusing the word employer. If such amount is not deposited by employer to the respective fund within the due date of respective fund, PF ka due date 15th March, 15th of subsequent month, and if any amount is deposited after the due date of fund, then it will be treated as an income of employer. We have already discussed in our example, and be disallowed to employer only. Okay, and here the due date means due date of respective fund, due date of ESI, due date of PH, due date of superannuation, and not the due date of filing the return of income. Return of income due date 31st March or 31st October. It is not a due date of that income filing date. Here we are talking about the due date of respective fund. Please remember that. Section 36, subsection 1, subclause 7. It says the bad debt deductions. If any person has debited the bad debt amount in his profit and loss account, but we have to first to see its nature, its brief explanation, and its its classifications. The actual bad debt and provision for bad debt. There would be two cases. One is bad debts written off. Another case is provision for bad debt, which we have already seen in your 12th grade or in your foundations. And if it is actual bad debts written off, then if it is that related to sales, for example, debtors have been written off, debtors balance have not been written off, then in that case it is called related to sales. In that case, it is fully allowed. It can be taken as an expenses in a profit and loss account as per Income Tax Act. But it is related to loan. For example, any loan given is not being returned back to us, so it is treated as bad debt, bad loan. So this is not allowed because it is not related to our business, right? And hence here it is not allowed. But it can be allowed for the money lenders. If my business is only giving and taking the loan, giving and receiving the loan amount, repay back the loan amount, then it can be allowed because its main source business is sanctioning and receiving back the loan, right? So for that business, money lenders or financial institutions, it is being allowed. That is related to loan. Okay. Next, if it is provision for bad debt, it is not allowed. But for banks, under section 36 1 subclause 7A, it is allowed. Okay. For example, in banks you might have seen the NPA, that is non-performance asset, for which the bank would treat some of the provision against that, and hence it would be in common in nature in the banking sector, and hence it would be allowed for the banking financial statements. Okay. Next, notes. There is some notes with regard to this. The debt should have been taken into account for computing the income for previous year or earlier. It should be taken into account. The debt should be there in your balance sheet. That's it. Or as current asset or whatever, current asset or long-term asset. Or bad debt should be written off in the books of account. That should be, for example, 1 lakh is a debtor amount. That should be written off, and there should be proper presentation. 1 lakh minus 1 lakh bad debt. That respective balance of debtor should be nil in the books of accounts. That proper presentation should be there. Bad debt should be written off in the books of account in the previous year in which bad deductions is claimed. Okay. Next, where the amount of such debt has been taken into account in computing the income. This is for reading purpose. In computing the income for previous year or earlier previous year on the basis of ICDS, that is income computation disclosure standards, without recording same in the account, such debt shall be allowed in the previous year in which such debt becomes bad, and it shall be deemed that such debt has been written off as irrevocable in the accounts, even though it has not been written off in the books of accounts. Even though second point says it should be written off in the books of account, but as per ICDS, as per income computation disclosure standards, it says, if it is says that it should be written off, that some portion of the bad debt should be written off, debtor balance or loan balance should be written off, then we are going to write off that balance irrespective of the fact whether it has been written off in the books of accounts or not. We are going to proceed with the same if it has been specifically mentioned by ICDs. Yes. Okay. Next, section 41 subsection 4. Why you are discussing now? Because it is related to bad debt. It says recovery of bad debt. You have written off in the bank. You have written off the bad debts, and you are claiming as allowable expenditures on the above criteria. If those bad debts have been recovered in the subsequent years, then what would be the treatment where deduction has been allowed in respect of bad debts? Let's say, for example, in this related to sales, we have allowed as a deduction debtor balance. We have treated as bad debt. We have written off in the books of accounts. We have accordingly we have claimed the deductions. If that debtor comes back in a subsequent year, let's say for 24-25, then the recovery shall be taxable as PGBP. That recovered amount should be taxed. In our example, 1 lakh minus return of 1 lakh, balance is nil. In the previous year, 23-24. In the 24-25, let's say 1 lakh amount or any of the lesser amount has been recovered. For example, 50,000 is been recovered, then that is also treated as an PGBP income in the 24-24 financial year. In the year of recovery, that is in the year of 24-25, whether or not the business or professional in respect of which the deduction has been allowed is in existence or not. For example, in this previous year, I have deducted as a deductions. I have claimed as a deductions as a bad debt. Let's assume I have sold my the business proprietorship to any other person. In the next year, that debtor came to me, where in which year I am not the legal owner. That is 24-25. Let's say I am not the legal owner of that. I have sold that business to any other person. He came to me. I am recovering that amount. Then also it will be taxed in my hand, because that benefit of written off had been taken by me, and accordingly the recovered amount taxation would also be charged on me. Okay. Same person, the benefit has been given, now the taxes have been given. If the bad debt had not been there in the 23-24, then it would automatically, my profit would be exceeded, would be increased, would have been increased to that extent, right? But I have claimed that benefit of written off or allowable expenses. I am charging with that recovered amount in the year of recovery, and hence it would be treated as a tax in the year in which it has been recovered, even though I am not the legal owner. Example, the 50,000 is a bad debt. I have claimed deductions. Allowed by assessing officer is 35,000. Disallowed by assessing officer 15,000. Out of 50,000, I had been allowed as a deductions only to the extent of 35,000. 15,000 had been disallowed. In a 23-24, I have recovered 30,000. So taxable amount would be the recovery amount, that is 30,000, minus disallowed earlier amount, that is 15,000. Because on 15,000 I have already paid the income tax amount, right? In brief, I am clarifying. In profit and loss account, you have stored as a 50,000 bad debt. But for like say example, your net profit before bad debt is 1 lakh. You are deducting bad debt of 50,000, so your net figure would be 50,000 taxable income. But assessing officer came to know that the 15,000 is not allowed, it is been disallowed, and it has been added back. So 50,000 plus 15,000, let's say 65,000, you have paid tax on that amount. You have already paid tax on 15,000, again that amount would not be taxed. So now the recovered amount, that is 30,000, the minus 15,000 would be reduced. So 15,000, the balance 15,000 can be taxed as a PGBP income in the year of recovery, that is in the year of 23-24 in this example. In the upcoming year, let's say remaining 20,000, 50,000, 30,000 recovered, remaining 20,000 has been recovered. Let's say for example in 24-25, then entire that 20,000 would be taxed. Okay, that is because we have already reduced the disallowed amount in the first instance. Now we are not reducing any amount. The whole 20,000, if it is recovered, would be taxed in the year of the recovery. Okay, I hope you understood. Next is section 36, 1 subclause 9. Expenses on promotion of family planning of employees. It is actually eligible SSE is company. The revenue, if it is a revenue expenditure, is allowed 100%. If it is a capital expenditure, allowed in 5 equal installments. Let's say if you have incurred the capital expenditure of 1 lakh, it would in the 23-24, 20,000 would be claimed as deductions. Remaining 4 installments can be claimed in the subsequent 4 years. Okay, simple. Next section 36, subclause 1, subclause 15 or 16. Securities transaction tax or commodities transaction tax, STT or CTT. In short, allowed as a deductions if SSC had held his shares, units, commodity as stock in trade. He should be a broker in that. If I am holding the shares as a capital asset, I am not dealing any of the transaction. I am only just in one. I am purchasing or I am selling. I am not into that business. I am just holding that asset. I am just holding the shares, mutual fund units. Then it would not be part of my business and it would not be considered as a stock in trade for me. But if I am a stock broker, then it would be considered as a stock share. For example, Zerodha, they are holding in Carvey, they are holding the shares, they are treated as a broker, their main business into that only. For them it is treated as stock in trade, for them it is allowed STT paid or CTT paid. Okay, next section 37, it's a general deductions. Any expenditure other than section 30 to 36 mentioned above shall be allowed as a deductions if the following conditions are satisfied. Expenses should be incurred wholly or exclusively for the purpose of business or profession. They should be exclusively used. There should not be any diversion would be there. For example, if it is personal in nature, that even though if it is purchased, expended for the personal in nature, but you have debited in your books of account, it is not allowed, and that's the meaning. Next, expenses should be revenue in nature. It should not be capital in nature. I think you have heard this several times in your foundation or 12th or 11th grade. Next, expenses should be legal. There should not be illegal expenses. For example, any of the illegal businesses that should be strictly avoided. Okay. Next, explanation for some explanation. Following expenses are treated as illegal and not allowed as a deductions. For any purpose, you have incurred in expenses for any purpose which is an offensive nature or prohibited under the law in India or outside India. For any expenses, for example, you are avoiding the repayment of any of the taxes by simply traveling to abroad. The traveling expenses cannot be allowed as a deductions for your business in the profit and loss account in India. So it is because it has been prohibited in nature, and if it has been offense, it is treated as offense. To provide any benefit or purchases to a person's whether or not carrying on a business or profession, and acceptance of such benefit or purchases by such person is also in violation of any law or rule. If you are receiving, if you are paying any of the perquisites or salary or benefit which are in prohibitive nature, that is also an expense incurred on that, should be not allowed as a deductions. And to compound an offences under any law for the time being in force in India or outside India, to support to compound any offences, that is also an expenditure incurred for the same, should be ignored, should be avoided, should be disallowed. That's it. Next, corporate social responsibility expenses. If you are a company, if you are incurring any expenses for CSR activities, then that is also not allowed for your books of accounts of the company. Next, allowability of some expenses, advertisement in brochure and souvenir and newspaper pamphlet published by political party, then that is also not allowed. If you have shown any expenses, related expenses, then should be allowed, should not be allowed. Next, gift to employee. If you are paying any gift to employee for which you have incurred some of the expenses, then it can be allowed in your books of accounts of the employer. Then shares debenture issue expenses. If you are any incurring an issue expenses with regard to IPO, that is initial public offer or right share issue, that is treated as a capital in nature and it is not allowed. Why it is treated as capital in nature? Because there would be changes in the capital formation in the shareholdings, and it is entirely changing the balance sheet figures, and hence it would be treated as capital in nature, but it is not allowed. We have already discussed there should be expenses should be revenue nature and it should be fully avoided. Next, buyback. If it is issue expenses is in terms of buyback of shares and bonus shares and debentures or loan issue expenses, then it is treated as revenue nature, so it is not allowed. So it is allowed. If it is IPO right shares, capital nature, not allowed. If it is buyback of shares and debenture, loan issue expenses, it is treated as revenue nature, it is fully allowed. Next, taxes, interest, penalties. If you are paying the taxes, interest or penalties, if it is related to direct tax, for example, you have paid the income tax amount of for 22-23 in the previous year 23-24, obviously, because 22-23 ka due date would fall in the previous year 23-24, and hence accordingly you are paying the income tax amount related to 22-23 in the previous year 23-24. If you are debiting the amount, the same amount in your profit and loss account, then that is fully disallowed. It is not allowed. That is why saying not allowed. If you are paying any that income tax amount after the due date, and hence obviously the interest would be leviable. That interest, if it is being debited to a profit and loss account, that's also not allowed. Penalty. If you are paying your income tax amount after the due date, let's say for 31st March, 31st December 2020 of the respective assessment year, then that penalty would be leviable, let's say 1000 or 5000 as the case may be, that's also not allowed. If you are paying any taxes, interest or penalties in terms of indirect taxation, then tax with respect to tax, that is CGST or SGST, that is been allowed. You might have seen in your balance sheet, you might have seen on any of the financial statements, you can be able to see the CGST and SGST tax paid, indirect tax paid, that is fully allowed. That interest portion with respect to that indirect taxation, that is also allowed. Not only CGST, SGST, but also custom duty and excise duty as a case may be. And interest also it is allowed. But penalty, it is not allowed, because penalty in the sense it says it is simply a prohibition of any respective law. That we have seen it should be legal, but penalty would be treated as illegal type, so it would be restricted, it would be disallowed. Next, premium paid by firm on the key man insurance policy of a partner, then that is allowed in the books of accounts of firm. Okay. Section 40AI. This we would complete in the last part of this chapter, but that is part 5, which we are going to publish in upcoming few days. So stay tuned. I think you have gone through the entire aspects of today's part, that is part 4, thoroughly. If you are not subscribed yet, please subscribe to my YouTube channel. This is C. Abhijith Acharya and signing off. Abhi CA Classes. Have a nice